So you're new to options trading. Let me guess. You look at your account and it feels like you're just constantly lighting money on fire. It's an awful feeling, right? But I'm here to tell you it's probably not because you're unlucky. It's because you're walking right into five predictable traps that catch almost every single new trader. So in this video, we're going to pull back the curtain on these five mistakes from letting your emotions take over to completely misreading the market's hype. And I will show you exactly how to avoid them so you can stop bleeding cash and start trading with confidence and become a profitable options trader. So the truth is, most beginners don't flame out because options are too hard. They fail because they make the same handful of avoidable mistakes over and over. They treat options like lottery tickets, buying them without understanding the force they play. So with stocks, you mostly just need to be right about the direction. But with options, you have to be right about the direction, the timing, and the volatility, which is the hype. It's going to do a lot of good for you. So a huge number of losses don't come back from bad market calls. They come back from these classic rookie errors. So by the end of this video, you want to know what these traps are, and you'll have also a clear game plan to sidestep, protect your capital, and start building the habits of a disciplined, profitable options trader. So, all right, let's get into mistake number one, which is maybe the most painful of all of them: completely ignoring implied volatility. So, a beginner options trader sees a stock all over the news. It's bouncing around like crazy, and they jump in to buy a call option, thinking it's a one-way ticket to the moon and they'll just get rich overnight. But then the trade goes nowhere or even loses money, even though they got the directions right. But how is that possible? It's because they bought the option when its price was massively jacked up by high implied volatility. So think of implied volatility as the market's hype meter. So it tells you how much a stock is expected to swing in the future. But there's a ton of hype, fear, or uncertainty, like right before the earnings report. IB goes through the roof. This makes the price of options, both calls and puts, way more expensive. So the beginner sees the hype, buys the call, doesn't realize they just paid a giant hype tax. Now, for that to be profitable, the stock doesn't just have to be going up, it has to be way more than everyone was already expecting. So this sets you up for a painful scenario called IV crash. Let's say stock's $100. You buy a call, betting on good news. The news comes out, it's great, but and stock pops to $102. You were right, but here's the problem: the uncertainty is gone, so the hype meter implied volatility crashes. So this crash in IV can make your options value drop so fast that it completely wipes out the gain you made from that stock's move. So you nailed the direction, but still lost money because you bought at peak height. So you can fix this. How do you fix this? You stop ignoring volatility and start using it to your advantage. Before you even think about placing a trade, ask yourself, is the IV for the stock is high or low? When IV is high, options are expensive. And this is a fantastic time for an option seller, which what I do. You can collect a juicy premium. When IV is low, the options are cheap. And this could be the time where you can buy call options, especially like leap options. And this knowing IV and how to trade with volatility is going to make you a much more successful options trading. The second mistake that I'm going to talk about is a really big one. It's like showing up to a marathon wearing a scuba gear. A beginner, a beginner options trader learns what a call and put are. They suddenly, know everything. And that's all they use. So they think the stock is going to go up, they buy a call option. The stock is going to go down, they buy a put option. But this is a huge oversimplification that totally messes with the power of options. So a real trading plan isn't just about picking a directions, especially in options. You have to include in your plan how much time do you think your idea will take and how you expect volatility will going to play out. The is does what it does. Nobody knows whether it's going to have a massive explosion next week or it's going to have a steady climb over the next 2 months, right? For example, let's say you think your stock is going to slowly grind higher for the next 60 days, right? The rookie movie here is to buy a call option that expires in a week. This is a terrible thing. That short-term option is being eaten alive by time decay every single day. For that trade to work, so you need to have a checklist that may look like this. What is the direction of the stock? Technically and fundamentally, am I bullish, bearish? Do I think stock is going to go sideways, consolidate for a while? And how long do I think this will take? What is the time for that? And it's going to help you pick a expiration date for your options. And the volatility. What is the IV right now? And what do you expect it to be? Because once you have these answers, you can find the perfect tool for the job. So if you're bullish on a stock for the long term, but IV is currently low, maybe buying a long-term options, leap option with a high delta around like 0.70 is going to be a right move. It's basically acting like owning stock, but requires less capital, and you will get the same profit that you could get from the 100 shares of a stock. Or you're still bullish, but right now it's going to be a slow grind. Selling a put will be an amazing idea, and it will let you collect that rich fat premium and use the time to your advantage, the time decay. And this discipline of matching the strategy to the outlook is what separates professional trading from gambling, and is going to make you turn options into a powerful financial instrument for your retirement. So, mistake 3. This gets everyone. You're scrolling through the option chain and you see it, a call option for a hot stock that costs you just a few pennies. And the stock is at 120 and there's a $150 strike call expiring next week for just $0.10. And your brain lights up. You think you're clever. You're saying for $10, I can just control 100 shares. Oh my God, I can make a fortune. But this is the siren. No, don't do that because it's one of the fastest ways to empty your account. Let me be brutally honest. Those options are cheap for a very good reason. The probability of them ever being profitable is incredibly low. So when you buy that $150 call option with the stock at 120, you're not just betting the stock will go up. You're betting it will scream past 150 within just a few days. That almost never happens. In nearly every case, the cheap option will melt away your account and your money is gone. And also never estimate the amount of money that you're going to lose, $10 or $100. And don't compare cheap with a good value. So this mistake comes from not understanding a key metric called delta. This is very important. You can think delta as a quick estimate of the probability of the trade that you're going into. So that cheap out of the money option probably has a delta of 0.05. And that means it has about a 5% chance of being worth anything at all at the expiration. So you're literally buying a lottery ticket with 95% chance of being completely worthless. Would you rather do that or would you buy being more expensive looking like and has a higher chance of winning? And another thing that is worse, the options are being destroyed and time decay. So every day that passes without that miracle move, a huge chunk of options, tiny value simply disappears. You're basically fighting a losing battle against both probability and time. So how can you fix this? You gotta stop asking, what's the cheapest option? And you need to start asking what options gives me a real chance to succeed. Because instead of cheap lottery tickets, consider a much smarter play. For example, instead of cheap lottery tickets and gambling, consider a much smarter play, like buying deep in the money leaps. Leap is an option with a year or more until it expires. And you can look for one with delta around 0.70, and it will cost you more, but you're paying for a high probability of success. An option, that option that acts a lot more like the stock itself. It's far less sensitive to the time decay, and you're buying time and probability. So if the stock is moving $1, that option is going to move 70 cents. So mistake number 4, having no exit plan and letting your emotions rule your trading strategy. So these strategies here, how a beautiful winning trade can go into a heartbreaking loss, right? So the beginner spends all their energy finding this perfect entry, but they give zero thought to the most important question: when am I getting out? Because without a preset exit plan, your decisions are hijacked by two most destructive emotions: greed and fear. So let's play this out in an example. Firstly, greed. So you buy an option and it takes off, right? You're up 50%, then 70%, then 90%. You feel like a genius. And your plan, if you had one, was to sell at a 50% gain. But now greed says, don't sell this. This is going to the moon. You can get more. So you hold on to it. Then the market turns, your 90% gain shrinks to 60%, then 30%. Now you're anchored to that high point, telling yourself, okay, I'll just wait for it to get back. But before you know it, you're back to even, and then you're down. And you let a huge win turn into a loser because you got greedy. Now for the fear scenario, you enter a trade and it immediately goes against you. You're down 30%. Panic starts to creep in. You don't have a stop loss. No plan for what's going to happen with this loss. So here the hope goes in. Hope says it'll turn around. Now your loss grows to 50%, then 70%, then 90%. And you finally give up and sell and take a massive hit to your account because you did not have a defined risk ahead of time. So here's the solution for you. You must have a clear exit plan for every single trade before you click to buy. You can even set sell limit orders for your profit targets, right? And you have to know your profit target. For example, for me, I never buy short-term call options. And if I'm buying a leap option, if I got like 10 to 15, 10 to 20% in a week, that's my profit target. If I got like 25 to 50% between 2 weeks to 1 month, then that's my another profit target. And I just stick to it, right? So for the stop loss, this is your eject point. It's the point where you admit the trade was wrong and get out to protect your money. For buyers, it actually depends whether you're buying a leap option or a short-term call option. Well, I don't do short-term call options, so I don't really. But if I have a leap option, I try to like see if the time is going to play out for me. And if I'm a seller, my risk here is the assignment of the 100. So you need to know your process and your risk management, because it's the only way to survive long term. It's protecting your capital, right? Okay, finally, we have the account killer, the 1-2 punch that takes out more new traders than anything else. It's trading too much and trading too big. This usually comes from being impatient, trying to get even after a loss, which we call revenge trading, or just getting caught up in excitement. Because of the leverage in options, this mistake can blow up your account past anything. A beginner often feels like they have to be in a trade all the time to make money, and they jump from one idea to the next without any real plan. After they take a loss, they feel a desperate need to make it back immediately. So they dive into the next trade they see, often doubling their bet size to get back to even faster. So this is called revenge trading, and it's one-way ticket to a zero balance. It's trading from a place of anger, not analysis, not. So making everything worse is having zero concept of position sizing. A new trader gets a hot tip or feels extra confident, decides to risk 20%, 30%, or even 50% of their entire portfolio on a single idea. And this is going to cause a lot of pain for you. Even a great strategy is going to have losing streaks. So position sizing is very important. You do not have to trade every single day. In fact, the best traders spend most of their time just waiting patiently for a perfect setup to come to them. And if you find yourself constantly clicking buttons, it's a sign that you're trading emotionally and it's time to step away. For me, when I'm trading volatility, I use the VIX levels. So whenever the VIX is low, below 2015, I try to get out of the trades and wait for the VIX to go up, and it always goes up. So by being patient and using strict discipline position sizing, you neutralize the single biggest trade to your trading career, basically your emotions. So there you have it, the 5 big mistakes that sabotage almost every new options trader. So we talked about ignoring the hype meter and volatility, mismatching your strategy with the outlook, chasing worthless lottery tickets, trading without an exit plan, and the account killer combo of overtrading and betting too big on one trade. So I know it feels like a lot, but here's the main takeaway. Successful options trading isn't about some magic formula or gambling on one trade that's going to go to the moon. It's about discipline and risk management and your cash management. That's it. Most beginners fail because they build terrible habits. By being aware of these 5 traps and focusing on sound strategies like selling premium when IV is high or buying high delta leaps for long term moves, you're already miles ahead of the crowd. So start simple, keep your risk small on every single trade, and focus on the process, not on getting rich overnight. If this video helped you out and you want to go even deeper, check out my videos on how to start options trading for beginners. For more content to help you trade smarter, make sure you subscribe, hit that notification bell so you never miss an update. Thanks for watching, and I'll see you in the next one.